We have to start with those wow, as some people are calling them, jobs numbers that came out, way above expectation. What did you make of them?
Look, the economy's been surprising on the upside for a while, so I was surprised, not shocked, that the job numbers came in that way. It was a pretty broadly strong report. Household survey, business survey, wage numbers, especially given that the weather was pretty bad in January in many parts of the country, which probably held the numbers down below what would have been their normal level. So it was a very strong number. And what that suggests is that despite the interest rate hikes of the Fed, there's a lot of strength in the economy. My instinct is that that is telling you, as I've been saying for some time on your show, David, that some combination of a higher neutral rate is the world we're living in, and possibly, quite possibly, spending has become less interest sensitive over time because there's less housing in the economy relative to GDP, because durable goods are less durable and so long-lived than they used to be, because there's more flow of income to the rest of the economy from larger government debts, and that makes interest rates operate in the other direction. So I think what we've learned is that what we might have thought would be substantially restrictive monetary policy based on the magnitude of the interest rate hikes really wasn't. It's still possible that that will feed through because of lags, but given what's happened to the stock market, given what's happened to credit spreads, I don't think that's very likely. And we've got an economy with a lot of underlying strength at interest rates where that would have looked unlikely some time ago. But I think those of us who have been expressing the view that the neutral interest rate is higher than people think because of deficits, and maybe that spending is less interest sensitive, I think those views are tending to be borne out.
Well, and we heard from the Treasury Secretary, Janet Yellen, this week saying she's not sure that the long-term interest rates will come back down. They may remain elevated, in part because of how robust the economy is. We also heard the Fed Chair, Jay Powell, say his concern isn't so much about reacceleration of inflation, but it just won't come all the way down. On the other hand, despite the wage increases, productivity is at high levels right now. I just checked, I think it's like 3.2% right now. Might that save us?
The answer is yes, yes, and yes. I welcome Secretary Yellen's recognition that given prospective budget deficits, given prospective increases in investment demand, we really don't know where neutral interest rates are going to be. I'll be interested in seeing what's in the administration forecast when it comes out. I think one would want to be guessing that Treasury bill rates will be averaging well above 3% through the rest of this decade. I think Chairman Powell is right to worry that in an economy where the natural population drives the labor force up by 50 or 75,000 jobs a month, and the economy is creating 200 or 250,000 jobs a month, that you may well not get inflation deceleration. I'm not quite as confident as he is that you won't get acceleration, especially given the geopolitical aspects around constrained shipping, around instability in the Middle East, and around deglobalization. So I'm not quite as confident as he is that we can rule out the possibility of inflation acceleration. But gosh, if it may have been looking several months ago like the balance of risks, inflation, recession was going in a certain place, the fact that the recession risk is looking more and more remote, and that, you know, today's wage number came in very strong, all of that makes me think that we still do need to be quite concerned about inflation. I think the Fed did the right thing by taking March off the table, and I would assume that after these numbers, March is completely off the table.